Hey everybody, welcome back to our Thursday night evening. I got my camera all in the wrong spot. Today we have got Tanner Oman with CMG. We're going to bring him on right now. We are going to talk about buy downs.
Yeah,
Tanner, introduce yourself again and let's
Sure.
get started.
Yeah, Tanner Oman with CMG Home Loans. We're right here in Rapid City. Luckily, CMG is the largest producer, I guess, highest volume mortgage company in the area. So we get to do a lot of work with a lot of people, which is pretty awesome. And the buy downs that Tristan are talking about kind of sounds a little boring, but they're actually very, very helpful, especially if you're not really liking where interest rates are at. This can really help out in making payments better, payments more comfortable, so on and so forth.
Right. Guys, let's start with interest rates right now. We're looking at 7% plus right now, or did they go down a little?
Today is actually a super good day. The CPI report just came out, so the Consumer Price Index report just came out, and the year-over-year inflation actually went from 8.2% to 7.7%, which is the biggest drop that we've seen, this year by time. Yeah. So it's actually a really good time right now based on today, because we actually saw a little bit of a dip in inflation, which is what we've been waiting for the whole year and what the government's been fighting with their regular increases of the Fed funds rate. So today, you were probably seeing more mid sixes to low sixes. One of the items that gets brought up a lot in regards to the affordability piece is looking at adjustable rate mortgages. And as an example today, our adjustable rate mortgage for our 10-year fixed adjustable rate mortgage, interest rate was about 5.75, which is very crazy to hear at this time. Even though, 4 months ago that was normal, but the last number of months, like you've been talking about, has been 7 or above.
Okay. Yeah. So let's talk about historically. When we used to talk about buy downs, that you're just buying down the interest rate. So what does that mean?
Yeah. So interest rates are very fluid. So, when you look online, you see a lot of just quoted interest rates, 6%, 7%, whatever it is. That's actually only one rate that you can choose out of all the rates that are available. So with that rate that's being quoted, you'll see next to it that there's some points terminology. That just means if you pay this amount of fees, you get this interest rate. But you could pay more fees and buy down your interest rate further. You could pay less fees and take a little higher interest rate, which is very good. You don't think you're going to be in the house very long, or you think refinance or something like that. So interest rates are very fluid. And normally when we talk about buying down, we're talking about just doing kind of a permanent buy down of the interest rate to pay a little bit more fees to get a little bit lower rate. Now, in this conversation, the buy down piece that we're talking about is more of the specific terminology. A lot of times you hear like a 2-1 buy down or a 3-2-1 buy down. All that really means is you're lowering your interest rate temporarily by 2% or 3% or whatever you choose for a short time frame to help alleviate the pain of the payment, with the higher interest rates. And then down the road, hopefully you can refinance to a fixed rate that will suit you for the long term once interest rates come down, which is pretty likely at this point that those interest rates will decrease in the next year or two.
All right, so I put this together, and hopefully I did it right. So on a 3-2-1 buy down, if the prom home is $300,000 and there's a 7% interest, the first year, the 3 would be 3% less, right?
Correct. Yep. So you'd be at the 4% the first year. Yep.
Right. So then the second year you'd have 5%.
Yep.
In the third year you'd have 6%.
Yep.
And this actually used to be 7 here. I didn't do my graphic right.
But yep. Anyway, the 4 through 30 would be 7.
We would be the 7. Okay.
Yep.
So go through this kind of chart with me. Make sure I did this right.
Yeah. So what you're really doing, if you've watched what interest rates have been doing, they're very, very inflated right now. So the likelihood of those interest rates coming down, especially when inflation has started to subside a little bit, is pretty high. So for most people that are buying houses right now, if you're locking in at 7, or in this example we'll just say 7 because that's what's we're using for the example.
Right.
That interest rate is probably only going to be something you have to keep for the next year, maybe 2 years, because you'll probably likely be able to refinance down the road with the likelihood of the interest rates decreasing. So in this example, if you did this 3-2-1 buy down, you could start your first year's payment actually at a 4% interest rate, which would decrease your monthly payment considerably. As you can see, I mean, we're talking, $500. Yep, exactly. So your first year, considerably less monthly payment, obviously helps out with budgeting and getting into the property. Second year, it'll go up a little bit to go to the 5% rate. You can see here it's still about $400 savings. And then the third year, still about $200 savings. But if we're refinancing you in the next year to 2 years, then you're at 4 to 5% interest that you're actually paying on a monthly basis. And then we can hopefully lock you in with that refinance and do a permanent interest rate of 4 to 5% or 5.5%. Yep, exactly. So hopefully the purpose of this is hopefully you never have to have a 6 or a 7% interest rate, because we keep you low in the beginning and then we refinance you low in the end, and you get to skip all of that, pain of a little bit higher payment overall.
Okay. So let's talk about then how this works. If I want to come and do this, what all is involved in the process? Do I need to be approved for it? What does it cost? That kind of stuff.
Yeah, so there'll be different costs depending on how big your loan size is and what interest rates we're working with, and how long of a buy down you do. So like I said, you can do a 2-1 buy down, or you can do a 1-0 buy down, and that just means how many years are you going to have the lower payments. So if you do a 3-2-1, that means you'll have 3 years of lower payments as shown in there. If you do a 2-1, you'll have 2 years of lower payments, so on and so forth. So there's different costs with all those pieces. As a good example in this scenario, I'd have to go run the numbers, but traditionally, $300,000 loan, 7% interest, you're probably somewhere around the $78,000 mark for like a 2-1, and then probably more around 12,000, 13,000 type range. Again, fairly close in costs for doing the 3-2-1. Normally, and I shouldn't say normally, but the last,
it's not exorbitant anyway. It's certainly
definitely doable. And the other benefit with right now, which Tristan, you've probably talked about this already, but this current market that we're in, it's a very strong market for buyers, which means when you're coming in and asking the seller, making an offer to the seller, you oftentimes can ask the seller for closing costs or have them cover closing costs. So with this scenario, let's say it is, you do a 2-1 buy down or whatever, and it's $8,000 to do it. More than likely, you can negotiate again with Tristan's help to have the seller cover that cost piece for you, so we can lower your monthly payment considerably without actually having you have to cover those costs.
Or a good portion of it anyway.
Or at least a portion, yeah. So it can be pretty helpful, especially in this market.
Awesome. Okay. And now we talked before about, so we did the 3-2-1, and in year 2, interest rates popped down to 5%. We want to refinance, and we mentioned that all that money that we put in there is an escrow account with you guys. Is that what's happening? We don't lose our money.
Exactly. Yeah. So what's going on is there's actually going to be a side account, and so you would just make that payment of $1,432 in this example, but that extra money will be sitting in that account to still make the full payment of the $1,995 that you can see in year 4 through 30. And then second year, you'd make the $1,601. We would take some of the money from that account and make the extra payments for you, and so on and so forth. So if you do refinance in a year or 2 years, there's still a good chunk of money that's hanging out in that account. And what you can do, there's really 2 options. One is you can just have that money applied directly towards your principal on the refinance. So let's say there's $3,000 left in there. We can just lower the amount of money that you owe on your mortgage by that $3,000. Or the other option is through request. So this is something that would have to be requested specialty, but you can request that that money be released to you as the individual doing the refinance. So we obviously don't want to guarantee that that's going to be an option for everybody as far as just kind of playing it safe, but more than likely that would be an option. Worst case scenario, you get to lower your loan balance and still keep that money.
Awesome. Okay. Now, one last, I suppose we should clarify. You still have to be approved for the total amount, right? The total 3-year amount or 7% rate.
Yep, exactly. So we still got to make sure that if for some reason rates didn't go down as expected, that you could afford and qualify for that. In this example, the 1995 rate plus your taxes and insurance and mortgage insurance, whatever factors come into play. So as long as you qualify for that worst case range, then we can use this to obviously put you in a better position.
Okay. Sounds pretty simple in theory.
It is actually, as far as, you, the buyer, in this scenario, there's not really much you have to do. You just, as long as you understand how the pieces are set up and we have, the costs available plugged into this account, then you pretty much just move forward as a normal purchase, and that's about the extent of it.
Right. Yeah. Which is usually it seems like programs have all these layers of attached to them, so this seems pretty easy. I think the main thing to be concerned about is just making sure that you understand that, hey, this is what you're paying right now. This is what you're paying, the 1995, and you might want to be prepared to have that for the length of things. We can't necessarily assume that interest rates are going to go down. So
correct.
It's something to consider in the process of buying that, hey, it might not happen.
Yeah, I always would like to put that caveat in, and do put that caveat in when I'm talking to people. There's a chance they might not. It seems at this point pretty unlikely, but there's 1 in a million chance, still 1 in a million chance, type scenario. So yeah, we always want to play it safe and make sure 3 years from now in this example, hopefully income goes up, everything else moves appropriately, and that you would potentially be comfortable with that top payment, knowing that hopefully we're refinancing you down to one of these lower payments permanently, and you're good to go.
Right. Cool. All right. Well, I think that was pretty self-explanatory. I don't know if anybody's got any questions out there. I don't see anything rolling right now, but hey.
Yeah.
So, all right. So, and if they can just call you and they can just kind of get started set up with you, and you can talk with them about the different options. I assume credit score might have a factor as far as how much money they have to put down for this, or
not so much. It's that's going to determine a lot of times their program that they use and stuff like that, which will change interest rates around based on program and credit score and stuff. But that's really the only major factor. It's going to come down to the loan amount and interest rate that we're working with, and then whether we want to do a 3-2-1, a 2-1, so on and so forth. So it's easily something we can break down.
Basically, and what you're comfortable with. And,
yeah, and how many years of safety do you want to give yourself?
Okay. Awesome. Well, thank you, sir. Appreciate you coming by and talking to us about this.
Yeah.
And Ooh says hi, so we say hi back.
Nice. Hello, and if you guys need me to nerd out on anything else, I'm always happy to.
Sounds good. I've got his. Of course, you can always ask me for Tanner's contact information. If you're on YouTube, that contact information will be below. I think on Facebook the same thing. It's down there somewhere. I put all his information there. So, yeah, get a hold of Tanner if you got any more questions. And have yourself a great Thursday night, everybody. Talk to you later.
Enjoy the weekend.